This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
Thank you, Jason. I would not have as much money today if it wasn't for you. Sissy and I both made a ton of money, and, thanks to you and your guidance and your show and everything. It's been great. And now cash flow for all your clients on top of it. Not only appreciation, but cash flow. You made a lot of people rich, my friend. You're a good man. Thank you, Jason.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Greetings, empowered investors, and welcome to episode 2215. Wow, what a tragic situation with the hurricane damage. It is absolutely amazing. I was actually in Tampa, Florida through the hurricane at a hotel. I had to evacuate one hotel after a speaking engagement and go to another hotel. They kicked everybody out. And it's just really devastating. I was in this hotel with all of these people that lived there locally, and they were sitting around the TV in the lobby and talking about the hurricane and so forth, getting reports from neighbors or people on scene, or looking at their home cameras and seeing some of them, their homes flooding and so forth. It's just really, really awful. What surprised me the most is the damage and the death toll in North Carolina, in Asheville of all places. It's amazing how far this damage reached. But as we have seen over and over again, these terrible natural disasters or man-made disasters like wars, they push prices up, they push rents up, and they push the prices of the ingredients of these houses up as the rebuilding efforts take place. All of those supplies, all of those materials, the lumber, the concrete, the copper wire, the petroleum products, the glass, the steel, and of course the labor and the energy, those costs get pushed up due to this devastation, as well as insurance prices. And we all know we've been dealing with higher insurance rates for the past few years. And insurance is something that we've continued to address quite a bit in our Empowered Investor Pro meetings every month. We've got one of those Zoom meetings tomorrow for all of you Pro members. We have a client who is going to be on with us who is really, really an expert, been self-managing for a long time, and he's going to talk about that in great detail, talk about really managing successfully and reducing tenant turnover and just having a much, much better experience. But we've had many insurance people come on over the years and talk about how to beat the game of the insurance issues. Just remember, though, income properties, just like businesses, just like corporations, are pass-through entities. And when your costs go up, when your insurance costs go up, all of that ultimately passes through to the tenant. I know that it may not feel that way because in the moment, it does not pass through. It's not like a commercial lease where you've got a triple net lease where the tenant is paying the insurance cost. But ultimately, it pushes rents up higher. And we've seen that happen over and over again. Well, let's get on with the show. So today, our guest will be Harry Dent. Harry Dent, but I'm giving him the nickname Doomer because he has been talking about doom and gloom for a very long time. He was optimistic in the early days, back when I discovered him in the late 90s and read one of his earlier books. He was very optimistic, and he said he was optimistic through 2013 because he predicted that around 2013, give or take a little bit, the baby boomers would be retiring, they'd be downsizing, they'd be putting their houses on the market. And, of course, he's not really a real estate guy. Okay, he's an overall economist and talks about financial markets and so forth. He has something to say about real estate. And Harry, he's been wrong all along. He's been wrong for a very long time, but maybe he'll be right eventually. We'll see. So this is the show for the doomers. The doomers will delight in this show. They'll love to hear what Harry talks about. So we'll get into that here in a moment. But let's look at some real data first, rather than these sort of kind of flip-in, unresearched things that houses are too expensive, or houses are more expensive than they've ever been, or I mean, it's just so elementary, some of this analysis you hear out here. And the assumption that is a wrong assumption, I'm telling you folks, there is a very incorrect assumption that is just this thing that goes on in a lot of human minds. And it's this idea that things have to follow a trend line, right? If someone analyzes the stock market and they're a chartist, right? They read charts, they do technical analysis. They think the chart tells us everything. But if they were right, then why aren't they trillionaires? I mean, the market is infinitely scalable, the stock market, right? It's really easy to scale in stocks. You make money, you put more in, you put more in, you put more in, you just keep doubling down on your bets, right? But look, no one gets it right, okay? No one gets it right. Even the best fund managers in the world make all sorts of mistakes, and arguably their returns are lower than just the index, right? Just buy the index. And so look, nobody really knows. But that doesn't stop them from being very self-assured, right? Okay, so let's look at housing here a little bit. If you're watching on video, I got a couple visual aids here. If not, I'll try and explain them to you for our audio-only listeners. So this article says housing demand firming up with lower mortgage rates. Pending contract data is getting better even during a seasonal decline period. So in other words, more homes are going from for sale to pending, even though we are in the lowest seasonal point of the market cycle. Okay, so for example, the weekly pending sales numbers in 2024, so now, right, the weekly pending sales, 362,000, well, I'll just round off for you for speed, 363,000 pending home sales. 1 year ago, that was only 341,000. And the year before that, it was 380,000. Okay, so there's your compared to what? Right? Pending home sales quite a bit better than they were a year ago. And everybody, of course, is complaining about lower sales volume. And I understand that because sales volume definitely decreased quite dramatically when we had these massive interest rate hikes. But sales prices, different than volume, kept going up and still keep going up, even though all the doomers and all the crash bros said they would decline. So this chart is really interesting because it really shows you what's going on exactly, okay? So pending home sales, again, 363,000 right now. A year ago, they were lower. And so there's 6.4% more single-family homes under contract than last year at this time, even though we are at a seasonal low point. So very interesting. We'll see how this plays out. Now, I've shown you this chart many times. It is the analysis we did along with our economist, Thomas, who you've heard on the show before. And it shows a mortgage qualifying, like a reverse mortgage sensitivity index, okay? And what I mean by reverse is that when rates go down, how many more people can afford to buy? So we used a baseline here of 7%. And of course, rates are wonderfully and thankfully lower than that right now. But again, a half a point drop, 50 basis points, 2.8 million new people can afford the median price home. A 1 point drop to 6%, 5.4 million new people can afford the median price home. And if we get to 5.5, which I think we will, Fannie Mae thinks we will, and several other big players in the market think we will, then 7.7 million new buyers can afford the median price home. So again, just assume maybe a third, give or take, enter the market. So the lowest point, that means a million more people have entered the market now. Now, this doesn't count 11 million illegal immigrants who have been let into the country by this idiotic administration we have. Not that I have an opinion about that, but folks, look, this is just basically treasonous. This is treason being committed by the current administration. They are basically giving your country away. There's no other way to look at it than that. They are literally giving your country away. They've let in about 600,000 convicted murderers. This is true. It's been verified. Multiple news organizations have verified this. Look it up, okay? And 11 million overall during this administration. So what does that do, though? It increases demand for housing. They haven't built 11 million new homes, okay? And granted, of course, these immigrants aren't going to buy a house, okay? They're going to rent. They're going to get government aid to rent the house, which will put more inflationary pressure because more government spending. Yet we've got this massive homelessness problem, especially among veterans. That is the most awful, evil, disgusting thing, that they would prioritize these criminal immigrants or any immigrants that are illegal over American people that fought for the country. I mean, look, I'm no fan of war, but that wasn't their decision, okay? It's just awful. It's just absolutely awful and treasonous what's going on. Okay, so here is First Americans research. So they say that this year's holiday gift is improved affordability. The RHPI, now remember, this is my second favorite housing index, okay? The RHPI, the real home price index it stands for, measures affordability by adjusting First American Data and Analytics House Price Index for purchasing power, how income levels and interest rates influence the amount one can borrow. These factors are expected to change in the following ways through the remainder of this year and deliver the gift that every potential home buyer wants this holiday season: improved affordability. Folks, we're right here in the pivot. Incomes have gone up, prices have gone up, rates have come down, housing affordability has gone up. So looking at this chart, okay, what this tells us, this goes back 24 years, okay, and it shows you the real house price index, okay? Now, the other thing to understand is the higher the RHPI, the lower affordability, okay? And then the other thing it shows is house buying power. And you can see here that house buying power was way high during the COVID era with low interest rates, and affordability was very high. And here we see that it went down with the interest rate hikes, and now it's more recently gone up. And in the gray part, they are expecting and projecting that it will become even better. So the real house price index will go down, meaning the real price of the house is lower, and the affordability will go up. And that's exactly what's happening. So, hey, Crash Bros, you've been wrong. You've been wrong for a very long time, and it looks like you're going to continue to be wrong. There's just no real data, no real well thought out data to support the crash thesis. And yes, I know some local markets are adjusting. And look, if some big exogenous event happens, of course, everything's up for grabs. Don't get on my case if World War III breaks out after Kamala is selected, if God forbid she is, okay? Isn't it amazing? For years, everybody said the Republicans were the warmongers. Now it's the Democrats that are warmongers, okay? Everybody said for years that the Democrats were the party of the people, of the common man. And that used to be true. But now the Democrats are the party of the rich elites, and they have totally abandoned the common man. But it just shows you the power of branding and how long a brand can last. And, you know, I saw that before I left the Socialist Republic of California in 2011. I would talk to people and they would still think, oh, California is so great. It's like the greatest place. And, you know, that used to be true. I mean, I remember as a kid growing up there, I loved it. It was the greatest place. And if you look at old movies, which Hollywood perpetuates these stereotypes that are just no longer true, you know, look at like any movie that depicts the Beach Boys or Gidget or any of these, you know, older TV shows or older movies, right? And it's just like California is this fantastical, great place. But now so many parts of California have just turned into utter shitholes, honestly. Now, granted, there are some isolated pockets, some little bubbles like where I used to live in Orange County, thankfully, that's, you know, such a beautiful, nice area. But there's a lot of pressure from the outside, the nearby areas that will affect those areas ultimately. So if you can, you know, I've told you one of the best things you can do to improve your lifestyle and your wealth is to move to a lower cost of living place. I know that everybody can't do this easily or doesn't want to do it, but just consider it. Just keep it in mind and have an open mind to it. Because when I went across the Arizona border, when I left California, my state tax rate went down by 69%. And then I moved to Nevada and Florida, and my state tax rate went down by 100%. It went to zero, no state income taxes at all. And when the housing cost is lower and everything is cheaper, it's really amazing how you can just build wealth so much more quickly. Okay, so here are some highlights from the First American report. As of August, right, real home price index highlights. First American Data Analytics and RHPI showed that in August, real house prices decreased. Did you hear that? The real house price. When you take into account the price of the house, the mortgage payment, the incomes increasing, right, and the interest rates decreasing. When you take into account these multiple factors, you get the real price of the house. That's why this is my second favorite index. What's my first favorite? The Hartman Comparison Index. Of course, I'm a little partial. The HCI is my favorite index for housing. But again, I don't have a whole team of economists and a zillion resources, so we're doing what we can with what we have. I always thought if I had the resources, taxpayer funded, of NPR to produce my podcast, my YouTube channel, I'd be big time. Can you imagine having a whole staff of like 30 people to help you produce a show? It must be nice. I don't know what that's like. But anyway, this is the homegrown channel, but at least the data is much more real here. Okay, so real house prices decreased 3.4%. Real house prices decreased 4.4% year over year. Okay, now this survey is as of August, so it's not, completely current. It's the most current one they've published because there's always a lag time, right? But 4.4% decrease in home prices in real prices. Now, the price of the house went up, but inflation happened, interest rates changed, incomes went up, right? So that's the real house price. And I didn't mention inflation before when I was talking about the real house price. Of course, you have to put inflation in there. Consumer house buying power, how much one can buy based on changes in income and mortgage rates. Important. Increase by 4%, okay? 4% year over year, and increased 4% between July and August, and increased 9.3% year over year. Wow, that's amazing. Median income has increased 3.1% year over year, and 56.7% since January of 2014. Real house prices are 32.9% more expensive than in January of 2000. Okay, so they are more expensive than they were then in January of 2000. Now, doesn't that prove the thesis I just mentioned? Yes, it does, Jason. It does prove it. Because imagine if someone were sitting in the early 2000s and they said, well, house prices are so high, they have to go back to the trend line. Just look at the chart. The chart said that they were cheaper in January of 2000, so they have to get cheaper again. No, they don't. No, they frickin' don't. Things can become permanently more expensive. Look around. A lot of things are permanently more expensive, and they're not going to get cheaper. I mean, maybe they will someday. How long do you want to wait? How many deals do you want to miss out on while you're waiting, right? Last thing, unadjusted house prices are now 62.4% above the housing boom peak in 2006, while real house buying power adjusted home prices are 6.9% below their 2006 boom peak. Everybody's saying house prices are so much more expensive than they were before the Great Recession, so they've got to come down. No, they're actually cheaper. Did you hear that? They're 6.9% cheaper. You've got to take into account, how are these people, economist, educated people, how are they going around not understanding these basic things that you have to adjust for inflation? You have to adjust for incomes increasing. You have to adjust for home prices. Of course, they're doing that. They're doing that one thing, okay? And then you have to adjust for interest rates. to get the real house price. That's what's important, is the real price, not the nominal price. So here, the report ends with a cautiously optimistic outlook. Now, why do they say that? Because they're coming from the perspective of home affordability. They are cautiously optimistic about affordability. That's what they're talking about, not about investing, right? That's a different concept. If mortgage rates fall to 6% by the end of the year, household income grows at pre-pandemic historical average of 2.9%, and nominal house prices increase by 3.9% annually. Now, that's actually quite low. So I guess they're saying if they don't increase as much as they probably will, then affordability will improve by 7% at the end of the year compared with 1 year ago. Industry estimates predict that next year will bring even lower mortgage rates. The potential for further relief in the coming year could be a game changer for those waiting to enter the housing market. You know what this says? It says buy, buy, buy. That's basically what you're hearing here. And this is not my data. I'm just reading you the report by a giant player in the marketplace, First American. They're a giant title company. They have a great economist. We've had one of their economists in the past on the show before. This is good data, folks. This is really good data. And then I shared with you some other data from Housing Wire. All right. If you haven't registered yet for our Wednesday upcoming monthly masterclass, this time we're going to be talking about Northwest Indiana, and it's going to be really good. I did a one-on-one call with one of our clients the other day. And by the way, if you want to book a one-on-one with me, I'm reasonably priced. So feel free and we'll get on Zoom and we'll discuss your portfolio and everything specific to you. So happy to do that. I'm happy to look at performance with you, help you complete performance, help you change them. Just ask any of our investment counselors and you can book a one-on-one with me. I was doing this with our client the other day. I was looking at 2 of his deals in Northwest Indiana, and those deals are fantastic. I mean, people are basically they're arbitraging their income there. They're getting Chicago income and they're paying Indiana low taxes. Isn't that great? That's a great deal when you can arbitrage, right? You can get the high income from one place in Chicago, which the incomes are very high, and then you can arbitrage it by living in a less expensive place. That's what the tenants are doing. They rent houses, and the rent to value ratios are phenomenal. So you definitely want to join us for this upcoming Wednesday masterclass. It's the second Wednesday of every month. And the link, of course, is easy. It's jasonhartman.com/Wednesday. jasonhartman.com/Wednesday. Do not miss this one. It's going to be really, really good. And by the way, thank you for all of your positive comments about our monthly meetings. We've had some great feedback. The last one was on second citizenship and offshore planning. And that's such a big topic. We couldn't even come close to covering it. We're probably going to do some follow-up sessions on that and with our asset protection attorneys and things like that. So we'll get to that, but you know where to get those people if you need them. All right, let's get to our doom and gloom session with my friend Harry Dent. Here we go. It is my pleasure to welcome Harry Dent back to the show. He is the author of so many books. I started following his work back in the late 90s. Yes, it's been a long time. His most recent book, it's been a while since that's been published. It's called 0 Hour. We've had him on the show to talk about that in the past, but he's back with us again to share his latest thoughts on the economy. Harry, welcome back. How are you?
Nice to be back, Jason.
It's good to have you. You're coming to us from Puerto Rico again. And
Puerto Rico, I've been here for 8 years. I've never regretted it, but been coming here since 93. I had a vacation property on Culebra for many, many years and finally built a house there, which is far more difficult than I anticipated. But I finally moved down here when I watched San Juan grow from a second world city into a first world city. Then I said, okay, now I can just move down here because it's far better weather than Florida. Less cold in the winter, and we're at least 6 degrees less extreme hot in the summer, and that's where Florida gets tough. Is in August, September.
Oh yeah, no question about it. Well, Harry, there's a lot going on with the economy. We've got this crazy political climate too. Tell us just your macro view of things. You have been talking about a bubble for a long, long time, and so far the bubble has not popped yet. But what's happening?
Well, first of all, I mean, and this has never happened. This is not a long bubble. This is by far 3x the longest bubble before this. In other words, this has never happened before. And the reason is every bubble in history has come in good times, like the early 1900s, which turned in the roaring 20s. When things get good long enough, investors and analysts and stuff just get all giddy and think, well, this is we've reached, as Irving Fisher said in 1929, the head economist there, a permanent plateau of prosperity, and people start thinking that way. And that's when stocks get overvalued, and then they bubble and they crash. And then you end up in a Great Depression when all these financial assets go down and wealth is destroyed and, businesses laying out, all that sort of stuff.
So you're saying, unlike Irving Fisher, you are saying we have not reached a permanent plateau of prosperity.
Well, we didn't back then, but this looks more so because this has been the longest stock market run. I take out COVID because that was totally exterior and stuff. That just came and went. We were right back at new highs. 15-year boom without a real normal recession. That has also never happened in over 200 years of the stock market's existence. So the reason for that is very simple. It was only in 2008-9 when Ben Bernanke was the Fed chairman, who studied the Great Depression in the 30s as his thesis. When he saw 2008 hit, he was thinking like me. And I was telling people, we were predicting before and after, 2008 is 1930. This is the beginning of a Great Depression, a major bubble in financial assets burst, and a demographic surge in spending peaks and turns down and slows for a long period of time. And then you have a big deflationary deleveraging of debt, detoxing of debt, and asset prices come down. And that's the difference between a long or deep recession like in the 1970s or early 80s and a depression like the 1930s, or what should have happened, Jason, in 2008 to 2022, 23. Now, for the first time in history, again, you got to remember the Fed was only invented in 1914, had very limited powers, wasn't expected to do anything but just provide cushions in a short-term crisis, okay, to keep things from just going berserk. The Fed realized, well, we got the power to fight this damn thing. And Ben Bernanke, again, studied the Great Depression. He recognized it. Anybody else would have thought it was something different. He did see it. And he threw $1 trillion in the economy in 2009, thought that'd be enough. Okay, so did Mario Draghi over in Europe. No, not nearly enough, because it was a long-term crisis, and that's enough to get you through 1 year, not through 13, 14 years. So what happens? They had to keep upping the ante, printing more and more. And here we are, $27 trillion. Now, I'm the only guy that's counted this out and broadcasting it. 19 trillion of that is nonstop government, larger than average government deficits. I haven't had one surplus since 2001, okay? And $8 trillion of money injected directly, and that's what they call money printing. Well, spending deficits, because they just borrow these with treasury bonds and pay them back 30 years from now or something. All of these are creating money out of nothing and injecting it into the economy. So that's how we got the greatest bubble. Every bubble in history, again, has lasted 5-6 years most. Late 24 to 29, late 99 to early 2000. That was almost 5.5 years. That's a typical how long a stock market can go crazy by itself in normal conditions in good times before the bubble gets so crazy it bursts of its own craziness. And again, that always happens. This time we've gone 15 years, 3 times. So it's because of the government, the nonstop and accelerating government, and this time fiscal stimulus has been 2/3 of it, 70% I'd say, and the monetary has been 30. Now, what happened is they finally overreacted to COVID, okay, 20 to 22. They, out of that 27 trillion I'm talking about, 11 of it came in the 2 years after COVID, and that caused this 9.1% out of nowhere inflation spike. And again, I got the best inflation indicator in the world, bar none.
What is that? Wait. What is that best inflation?
It's workforce growth. It is the cost of incorporating new workers in the infrastructures and new technologies they bring and require early on in this, before they become productive and earn and spend all this money they're going to do. that inflation comes in the early stages when people are entering the workforce. People think that high growth causes inflation. Our best growth periods in history, from the roaring 20s to the 50s to the 90s, had low or falling inflation. So I knew that wasn't the case from the beginning. So my research, I kept digging, realized no, workforce growth, and that correlated with the biggest 70s inflation in history. And that says that inflation would come down to about 1 to 2% in the 80s and 90s and stay there for a long time. Okay. And that's what was happening. We had this high growth economy with low inflation. But when COVID came, 11 trillion in 2 years, well, that suddenly caused 1% inflation to turn into 9%. And when that happened, oh my God, we got a tight monetary policy, 525 basis points, the biggest since the last inflationary crisis was peaking in 80, 81. And I mean, that was the biggest ever, but it wasn't just the 525 basis points. They had run the balance sheet from 1 trillion up to almost 9 trillion. That's $8 trillion of money also poured in with these.
Okay. Harry, wait a sec. I just want to establish a few things here before we go. You're providing a whole bunch of information like a fire hose here. So first off, you said a moment ago, we were talking about the bubble. You talked about how the Great Depression happened in the 30s and, the Great Financial Crisis, 2008, et cetera.
After a bubble in financial assets, after the roaring 20s bubble.
So I just want to make sure the listeners understand, where do you think we are? Clearly, you think we're in a bubble, right? Correct me if I'm wrong. But
we're
what do you
in
think?
An extended bubble. The natural bubble would have peaked already.
Right.
In 2021 was when the natural bubble would have peaked, and now it's extended even 3 more years out, greater. Because the government keeps fighting it bursting.
Sure.
Ben Bernanke.
Okay, wait. Hang on. Hang on a second here. So define.
So do you want me to bring in Mr. Rogers? I can do that.
Yeah. No, I just want you to define, what does that mean to people? We're in a bubble. The impression is the bubble's going to pop. And
yes. Okay.
When the bubble pops, what happens? Asset prices fall?
Bubbles refer not to the economy as much, but to the financial assets, the stocks and the real estate.
Okay.
That reflect the bubble. In a bubble, these things usually go up, but they go up in a measured way commensurate with the economy and earnings. A bubble happens when the economy goes up long enough and people feel good enough about it, and it keeps going up a little better, that people start saying, oh, well, this will go forever. And so now that's when they start bidding up the assets more and raising the valuations. If you never thought there'd ever be a recession or depression again, any asset you're investing in would be worth more today, because that's the biggest thing that destroys value down the road. So people get giddy in a boom, and that's what happened in the roaring 20s. It didn't happen as much in the 1950s, but it happened big time in the 1990s. We had a tech bubble, the first tech bubble, and that was the first real stock bubble, and very similar to 24 to 29. That was the first one since the roaring 20s. Bubbles are rare, okay? But now we've had 2 stock bubbles and 2 real estate bubbles, the first one on the lag, and now both together. So this is double bubble, Jason.
Okay.
Which is very dangerous.
Can you provide any opinions on timeframes for us of when this bubble will pop and what that's going to mean to people? Like, what will happen when it pops?
Okay. The time for it to pop really is in the current time frame, only because, you got to remember, this would have popped a long time ago. Government keeps stimulating, keeps upping the stimulus. Again, this 27 trillion. If anybody, any economist or any forecaster in the early to mid 90s had told you that we're going to have a big slowdown and governments are going to print, the US government would print $27 trillion out of thin air to fight it, people would have thought, oh, that'll never happen. Okay. That's how crazy this is. Okay, so a bubble happens when financial assets start to go up much faster than the economy would warrant, because they're just thinking it's going to get better and better, and we've reached this permanent plateau of prosperity that Irving Fisher quoted in 1929. He quoted that right as the stock market was about to peak. Okay, that's what asset prices and the economy being good. People get delusional when they don't get their ASS kicked. Okay. Once in a while. So then you get a crash and you get a deflation to bring things asset prices back down to reality. And that's painful when people are losing that much money. Banks are failing. They lend against all those houses and buildings. People lose money in their stock portfolios, and then they spend less money. Oh my gosh, I got to work. So it causes this whole tumble down effect where one thing just makes the other worse.
Got it. Okay, so timeframes. Any opinions on timeframes as to when the bubble will pop?
The worst bubble and downturn took 34 months from the top of the stock market to the bottom to crash. 89% unemployment went to 25% on a lag to that. That was the worst downturn, and that's as long as it took. So I'm saying if we're getting ready to peak here or soon, this downturn will take us probably into late 2026 to mid 2027. It's going to take at least 2 years. It may happen a little faster this time because it's been stretched so hard. But
I want to distinguish. That's when the downturn ends or starts.
The downturn starts soon and it ends 2 to 3 years from now.
Okay, so it starts what, next year?
I'd say the stock market could have peaked in July here, by the way. Mm-hmm. Real estate will tend to peak on a bit of a lag. Things should be falling the strongest in 2025, if I'm correct. And then they'll continue to kind of staircase down into at least late 2026 and probably into early to mid 2027. It just depends on how fast it goes.
Yeah, let's talk about real estate for a minute, since I'm heavily attached to real estate. And I would like to see a little bit of a price adjustment so we could have a more normal market. But inventories are still very low. Yeah. They're about half of normal. And people have been calling for a real estate crash for quite a long time. And I've been disputing that. And everybody's told me I'm too optimistic. I have a vested interest. There's a conflict of interest. And, I've been right and everybody else has been wrong so far. Of course, things will change eventually. But you can't create more real estate supply very easily. There's a real
but the average person also can't pay $1 million for a damn teepee. Okay, it's getting there, Jason. But $400,000 for an average house in Ohio that was $100,000 just 20 some years ago.
I got it.
That's something somebody has to pay for, the interest and the mortgage.
Right.
For the same house. It'd be one thing for the same house.
Well, number one, you have to adjust that for inflation, of course. Right. So the dollars are less valuable.
Inflation has probably doubled in this period, but overall this bubble's gone up 4x. Financial assets like real estate would have to come down 50% just to be in line with inflation.
But the problem is humans tend to just think, Harry, that because there's a trend line, you look at charts, right? That's one of your expertise, right? Just because there's a trend line in the chart, that things have to move back to the way it used to be. I believe that something could become permanently more expensive. Nothing's ever totally permanent
in every era than the one before, because more people, more infrastructures, and generally the cost of living goes up. Partly, Jason, the real reason is we're always delegating more and more of the tax. I mean, the Little House on the Prairie, that guy, Michael, whatever his name, did everything.
Langdon.
You delegate and everything goes up, but you're specializing in what you do. So you may be making 3 times the income, but by delegating, everything may cost you twice as much. There's always inflation. Expanding new young people entering the workforce means you have to pay for those offices and infrastructures and training up front, and you get the benefit from that new worker getting more productive over decades. Okay, so inflation always will happen, and it happens mostly when new people are entering the workforce, and that's why the biggest entry of new workers in the workforce was from the late 60s into 1980, and that's when we had the highest inflation. It had nothing to do with government deficit. They blamed it on government deficits back then, which was 90% wrong.
And we'll be back with a lot more on this topic with this guest on our next episode. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.